Hi, everybody. I'm Ric Edelman. Thanks so much for joining us for this presentation today. This is a very much anticipated conversation based on a white paper that I released a couple of weeks ago, and I'm really excited to be partnering with Coinbase on this event, and happy to welcome to this presentation Anthony Basili. Anthony, good to see you.
Thanks, Rick. It's great to be here with you.
Anthony is the president of Coinbase Asset Management, who's been in this industry first in TradFi and has moved over to the digital asset side. He has been around a long time and is now leading Coinbase's focus on the asset management part of their business, which up until recently, Coinbase never had. So Anthony, tell us what's going on at Coinbase these days, and then we'll get into my presentation.
Sounds good. It's an honor to be here, Rick, with you and the team at DAC-FP. So thank you for hosting this today. So just a little bit about myself. I was with Coinbase now for 3.5 years. Recently moved over to Coinbase Asset Management, which is a wholly owned subsidiary of Coinbase. And it's through Coinbase Asset Management that we are building investment strategies. And these investment strategies are both passive and actively managed strategies that allow different types of investors, institutions, RIAs, and others to access the crypto markets in risk-managed ways. So very excited to be here to share with you all a bit more what we do. This is separate from Coinbase. The Coinbase isn't directly offering these products. This is offered by Coinbase Asset Management. Just to be clear, there is a distinction between the asset manager and the parent company. Now, just real quick to make sure everyone orients themselves, when they think about Coinbase, they think about the consumer brand, where a lot of investors hold assets in their wallet. They hold digital assets. They're holding stable coins. They're holding Bitcoin. They're trading on the exchange. We have also the institutional business, which is part of the headquarters. That platform is delivering custody and prime services. A number of different RIAs are now clients of Coinbase Prime. They're keeping their clients' assets safe inside that qualified custodian, and they're getting other services around that. The asset manager, Coinbase Asset Management, where I sit today, is a U.S. registered RIA. And we're also an offshore, we're SEMA under Cayman licensed investment advisor as well. So we handle discretionary funds for U.S. investors and for offshore investors today. We're about 734 million in assets under management. And we've built a number of different strategies. We'll cover some of those throughout the call today. Some of them, and the important flagship product that we've launched is called the Coinbase Bitcoin Yield Fund. And it's a very simple product. We allow investors to in-kind their Bitcoin into a fund, of which there are many, many millions of investors who are long Bitcoin today, looking for ways to generate yield with that Bitcoin. We allow them to in-kind the Bitcoin, and then we as an asset manager go and generate yield on top of that exposure. We're building strategies that are allowing people to lend USDC, stable coins, and generate yield on those. We've also built other solutions in the tax loss harvesting space. We built indices, so the Coin 50 index, and what we'll talk about today, importantly, is a store of value index, which we think is going to be a really big topic as more and more investment advisors are thinking through what is the purpose of Bitcoin? Why are we talking about it as a store of value when we already have gold? So the store of value index is going to be a really big hot topic. The background of the firm, we're 16 people today at Coinbase Asset Management. We come from places like AQR, Bridgewater, BlackRock, Millennium, and many, many others. Very, very astute and well-rounded team of investors and risk managers across the firm here. And so we're really grateful to be here with you, Rick. I think in terms of the focus today, when we talk about going beyond 60-40, and we talk about maybe what you call the death of 60-40, and we say that the crypto allocation should be 10% to 40% in a portfolio. This is a profound shift in portfolio construction, but it's not new. In my history at BlackRock, prior to coming to Coinbase, we were focused heavily on bringing alts into the institutional portfolio. And most institutions today sit on like a 30% bond, 30% equities, or 40% equities, and then 20 or 30% of alternatives and some other stuff in there, like commodities. So this transition into alternatives has been around for 2 decades or more. And it's important for folks on the phone today to think through this as not a new and novel trend. The movement away from 60/40 has been around forever, and now we're saying crypto should be a part of that allocation as well. And just to cap it off, Rick, what we're doing at Coinbase Asset Management, we're building strategies that advisors can use to allocate beyond that 60/40 portfolio and bring diversification and hopefully some of that upside convexity into their client portfolios.
Well, I really appreciate that info, Anthony. I'm really impressed with what Coinbase is doing, moving beyond what it has traditionally been known for as a crypto exchange for retail investors, moving toward not just institutional through Coinbase Prime, but now moving into the asset management world. And clearly, we're seeing the TradFi world and the crypto world coming together, and Coinbase is kind of at the top of that pyramid. So I'm excited for your new role as the president of Coinbase Asset Management, and we're going to talk more later on in today's session about these strategies and investment opportunities. So we'll come back to all that. So that's Anthony Basile, who's the president of Coinbase Asset Management. Anthony will be joining us in about 45 minutes from now. This webinar is an unusual format. Normally, if you've been to our prior events, you know that it's a conversation between me and some experts in the field. We're doing a little bit different here today. This is going to be a longer event. It's going to be up to an hour 15, even maybe up to an hour and a half, as opposed to the traditional 60 minutes, because we have a lot to convey, a lot of information to share with you today. I've been kind of blowing up the internet over the past month when I released my white paper on the fact that the 60/40 glide path is dead, obsolete, and must be replaced. And I'm going to share with you today why I made that statement and why I'm recommending that portfolios hold somewhere between 10% and 40% crypto in a diversified long-term portfolio. So let's launch right into it. And I'll begin, of course, not financial advice, DYOR, do your own research. Bottom line is we must update the 60/40 glide path. And I'm going to do a spoiler alert right from the start. The new allocation model, we know what the traditional one is, stock and bond. It's now stock, crypto, and bond, meaning you should hold 70 to 100% of client portfolios in stock and crypto and 0 to 30% in bonds. And we're going to delve all into this. Further detail, conservative portfolios should have 10% in crypto, moderate portfolios 25%, and aggressive investors 40%. There are two reasons for this, and this isn't getting all that much attention. And all the conversations I've seen online talking about my white paper, all the interviews I've been doing, these two reasons are not getting a whole lot of attention, but they're the real key, and they have nothing to do with crypto. First, longevity. Second, it's brought about by exponential technologies. Let's dive into these so you understand what's going on. And as I go through this conversation today, type in your questions into the Q&A box here on Zoom. We're going to have a lot of time for Q&A. I'm going to go on here for probably 40 minutes or so. Anthony will then join me. We'll have a dialogue for 10 or 15 minutes about this conversation, and then we'll be tackling your questions in the Q&A. So type them in now into the Q&A box here on Zoom. Much of the conversation I'm going to share with you comes from my book, The Truth About Your Future, which was a New York Times bestseller, and my #1 Amazon bestseller, The Truth About Crypto. And it all begins with longevity. And longevity starts with nanotech. Think back to the you tell me, the 1970s, when a single computer filled an entire room. Well, by the 1980s, that computer sat on a desk. By the 1990s, it sat in your lap. By the 2000s, it fit into the palm of your hand. By the 2010s, it fit on your wrist. And the scientists are telling us by the end of the decade, it'll be the size of a grain of rice and implantable in the human brain. And they're already doing early work on this for people who have paraplegic or quadriplegic conditions. Scientists have discovered essentially that the difference between sand and silicon is how you rearrange the atoms. The difference between coal and gold is how you rearrange the atoms. The difference between an old, sick individual and a young, healthy person is how you rearrange the atoms. Think about the human genome. When they first figured this out, it took 13 years and cost almost $3 billion. Today, it takes 2 weeks and about $200. And by the end of the decade, it'll be a free app in your smartphone that'll be instantaneous. This is why there's no such thing as breast cancer anymore. It's called the BRCA1 gene. Scientists have realized that all cancers can be boiled down to their individual genes. So we don't call it breast cancer anymore. We refer to it by its genome, BRCA1. And they're projecting that by the end of the decade, all cancers are going to be named by their genomes. That's just the beginning. We've got to look at major medical innovations that have occurred recently. Go back 10 years ago, CRISPR technology, at the time called the breakthrough of the year, allowing surgeons and scientists to add missing genes directly into the DNA or to remove bad ones. They're now actually treating babies while they're still in the womb with this technology. That was then 10 years ago. Today, the big excitement is about focused ultrasound. I'll bet you haven't even heard of this one. It's called the best kept secret in medicine. With focused ultrasound, there's no surgery, radiation, or chemo. It hits the tumors at the molecular level. Surrounding tissue is unharmed. That means there's less risk of infection, hemorrhage, and tissue damage. There's no pain or side effects. And it's done on an outpatient basis, which means rapid recovery is available. The FDA has already proved this for dozens of treatments. Trials are underway for hundreds more diseases. And then what's coming after that? The Human Cell Atlas. The first draft of this is due this year. We know the human genome has 24 chromosomes, but there are 37 trillion cells in the human body. The question is, how many different types of cells are there? They've already found 3,000 in the brain, 137 in the gut. And with the draft that they're going to be coming out this year, they're going to be able to tell us how to affect the human genome, treating all kinds of diseases. Bottom line is this. Scientists are telling us that by 2040, they're going to have cured the leading causes of death today. You see it on the screen: heart disease, respiratory illness, diabetes, cancer, obesity, addictions, even Alzheimer's. Think back to 1800, the leading causes of death in America included pyemia, puerperal fever, syphilis. Have you ever even heard of those things? For a woman to get pregnant in 1800, that was a death sentence, as childbirth killed both mom and baby far too often. 20% of children never made it past age 5. That was then. Innovations in medical technology cured those. They are no longer the leading causes of death in America. Fast forward to the 1900s. Leading causes of death: dysentery, cholera, TB, typhoid, and scarlet fever. When's the last time you heard anybody in America dying of cholera? Medical science eradicated those. And today, medical science is working to eradicate the leading causes of death of heart disease, respiratory illness, diabetes, cancer, obesity, and so on. They're projecting that by 2050, the leading causes of death will be accidents, murder, suicide, overdoses, pandemics and war, and euthanasia. Euthanasia, as I wrote in my very first book, The Truth About Money, published way back in 1997, 30 years ago, I said that the big social debate of this century won't be the abortion debate, it'll be the debate about euthanasia. And it's already happening. Bottom line is this. I've spent a lot of time in the study of aging and longevity. I've served on the advisory boards at the Stanford Center on Aging and the Milken Institute Center for the Future of Aging. I've worked with MIT's Age Lab. And the scientists that I've all talked with pretty much all say the same thing. If you're alive in 2030, you are likely to live to age 100 and beyond. They're suggesting that babies born this year are likely to live to 150. So this isn't just a baby thing for the future. This is a current thing right now for your clients who are in their 50s and 60s. Odds are really good. If you make it to 2030, you'll make it to age 100 or beyond. And that is why people are asking the question, will my money last as long as I do? And that is why we must update the 60-40 glide path. You know what it looks like. You start at very young ages, a brand new investor, 20s or 30s or 40s, they put 100% of the money into stocks, right? Because you know they got 50 years to go, they can afford the volatility, they can handle the ups and downs of the market. As they age and as their assets grow and their need for income rises, you reduce the equity allocation. By the time they're in their 70s, you've only got maybe 40% of their money in equities. By the time they're in their 80s, they're maybe 20% into equities. And by the time they're 90, they're totally out of stocks. It's all in bonds because they're generating income. That's the traditional glide path. It's out of date. We now need to have a glide path that looks like this. Far more equities for a far greater period of time. Owning a substantial allocation to equities well into your 80s and 90s, because people are going to be living that long, and you need to be able to earn enough of a return net of inflation and taxes to stay current with the cost of living so that you can generate the income you're going to need for as long as you're going to be alive. Just run the numbers, right? Most advisors, when they run financial planning projections, they assume the client will be dead at 85 or 90, maybe 95. Do you run it too? And everything looks great. If my client lives to age 90, they got plenty of money. Rerun those projections, assuming the client lives to 100 or 105. Guess what's going to happen? It'll blow up on them. They will run out of money before they die. This is why we've got to acknowledge the longevity curve, which is unprecedented in human history. So how do you manage assets in an age of longevity? It's a very disruptive environment because of the technological innovations that are allowing innovation and longevity to occur. Best example is Kodak and Instagram. Kodak, one of the best known brands, 130-some-year-old company, over 100,000 employees, one of the best brands on the planet. In 2012, Kodak files bankruptcy. Why? Because it couldn't adjust to digital photography. And along comes Instagram, which is only a year and a half old, only 13 employees, and the year Kodak files bankruptcy, Instagram is sold for $1 billion because it capitalized on this new thing called digital photos. This has happened in numerous cases. Disruption destroys companies. Tower Records was destroyed by iTunes. Borders Books wiped out by Amazon. Blockbuster killed by Netflix. Anybody remember Encyclopedia Britannica? Seriously? Or how about classified ads killed by, well, pretty much everybody? This has been going on for hundreds of years. The horse and buggy was destroyed by the Model T. So who's at risk to technological obsolescence? We'll start with life insurers. Think about it. If you're going to live to age 100, do you really need life insurance? By the time you die, your children will be in their 70s and 80s. Do they really need life insurance by that point to get proceeds from your estate? I don't think so. If they're going to need the money, they're going to need it decades earlier than your death. So we're expecting a big decline in the number of people who buy and hold life insurance. Same thing for disability insurance. You're not going to suffer a disability because medical technology will quickly and easily fix whatever broke in your body. Ditto for long-term care. It's highly likely that today's 5-year-olds will grow up never having heard the phrase nursing home, because today nursing homes are a one-way ticket. You walk in, but they carry you out in a box. That's not going to be the case of long-term care facilities in the future. They'll become disability centers, rehab centers. You're going to walk in and you're going to hop, skip, and jump on the way out because they'll have fixed whatever was ailing you. Similarly, annuity marketers are in serious trouble because annuities are all based on backward-looking actuarial data. They were built on the promise that they're going to give you lifetime income, but they were expecting that lifetime to be to age 80 or age 90. What happens if all of their annuitants live to age 100 or 110? Will they be able to make those monthly payments to all those people for all those years longer than they had actuarially anticipated? I don't think so. I think we've got a big crisis coming in our country when today's annuity holders reach their 80s, 90s, 100s and discover that the annuity companies cannot live up to their promises, and those monthly payments disappear. Auto insurance is also going to go away. Many of the car companies that are developing self-driving vehicles have already said they're going to include auto insurance in the price of the car. Why? Because they know self-driving cars don't get into car accidents. They don't speed, they don't run red lights, they don't drive drunk, they don't fall asleep at the wheel, they don't double park. Therefore, the likelihood of an accident is much lower, and the nature of an accident, should it occur, will be far less severe. So who needs auto insurance? In fact, who needs autos at all? We're already got Waymo. We already have Uber. The automobile you own is parked 95% of the time. This is why people are saying, the hell with owning a car. I'm just going to use a self-driving car like Waymo, or I'm going to go call Uber or Lyft and just treat it like an elevator. I'm going to call for one and I'm going to get in the first one that shows up. And when it's done taking me where I want to go, it'll go to the next person and take them where they want to go. If we eliminate personal ownership of cars in a massive way like this, the auto industry could find itself selling 80 or 90% fewer cars than it currently does, putting that industry at major risk. In fact, the entire crash economy is at risk because if those self-driving vehicles don't get into car crashes, we don't need auto body repair shops. We don't need paint shops. We don't need claims adjusters. The entire crash economy is going to evolve, largely disappear because of technological innovation. This even puts a threat to municipal bonds. Many small towns in America get a lot of their revenue from speed traps of tourists. Well, if self-driving cars don't speed, where are those little towns going to get the revenue from parking tickets and speeding tickets, putting their revenue bonds at risk? The energy sector is also being threatened as we make the shift from fossil fuels to nuclear and to solar. So this is a big threat for those industries. Banks and brokerages are under threat because of blockchain technology. But while there's a lot of scary stuff for existing businesses that are titans of the Fortune 500 today and have been for 100 years, there's an equal opportunity going forward for the next 100 years. Electronic sports. You know, you can get a college degree in esports now. It's going to be a $6 billion business by the end of the decade. Drones will be a $55 billion business. 3D printing, $100 billion. AI, almost $200 billion. Wearables, 186. Robotics, 232. Big data, almost $500 billion. The sharing economy, which we also call the gig economy, 800 billion. Safety and security, 1.1 trillion. Blockchain, 3 trillion. The Internet of Things, 4.5 trillion. The metaverse, 5 trillion. Tokenization, 16 trillion. And Bitcoin projected as high as $19 trillion in value. Today, by the way, it's around almost 4. So that's a 4x increase, almost 5x increase just in the next 4 years. Bitcoin itself projected to be a massive increase in price along the way. 20 years ago, world GDP was about 40 trillion. It's today around 80 trillion, and it's going to double again over the next 20 years to almost 200 trillion. This is all pretty darn exciting. And so we want to shift out of the broad look of what's happening with futurism and technological innovation, the focus of my book, The Truth About Your Future, and get very narrow and specific on the subject of crypto. The Bank of England said it most succinctly: blockchain could transform the entire world's financial system. Already 3 out of 4 TradFi firms are developing blockchain initiatives. This year, they're spending, the market is 176 billion. It's projected to be 3 trillion by the end of the decade. PwC says it's going to add nearly $2 trillion to global GDP. The technology is popular for a reason. It lets businesses operate faster and cheaper and safer with greater transparency and inclusion. This is a big deal. JP Morgan itself says blockchain is going to save banks $120 billion a year. And I'll give you just one example of how powerful this is, not just for the world economy and for the financial sector, but for crypto itself. We're going to look at the example of cross-border transmittals. This is right now a market that's about $195 trillion. This is people and businesses moving money from one to another. Cross-border, meaning going from the US to Europe, from the Europe to Asia, Asia to South America, South America to the US, it's whatever. Two parties, two individuals moving money from one to another, crossing a state line. Only 3% of that market is done using crypto. It's projected that by the end of the decade, the market is going to grow to 300 trillion and crypto's share of it will increase to 20%. That's a 7x increase from where we are today. And here's why it's happening. If you want to send money overseas, you've got to do it either with Western Union or a bank wire. It takes up to 5 business days. The cost is an average of 6%. It's 20% if you're wiring the money to sub-Saharan Africa. And you've got to do it with the SWIFT system, the international banking system that everybody uses. That is the state of the art. It's ridiculous. You can actually fly the money from New York to London faster than you can wire it there. Along comes crypto. With the Solana blockchain, you can send that money in less than half a second. The cost is a tiny fraction of a penny, and you can do this globally 24/7, 365 with no intermediary. You don't need a bank middleman to make the transaction happen. This is why everybody's excited about it. But what's interesting to note is that people are only a very tiny piece of the total remittance market. Only 1.2 trillion are individuals moving money from one person to another. It's often an immigrant who moves to another country for economic opportunity, sends money home to mama who's still in the old country. That's only 1.2 trillion of the 200 trillion of total remittances. The rest of the money is done by governments and corporations. This is big business. Ever hear of Kinesics? Kinesics is a blockchain owned and built by JP Morgan. I love it that Jamie Dimon says he hates crypto. They're one of the leaders in blockchain technology. Kinesics is their own private blockchain. It's been around for 4 years. They do $2 billion a day of daily transaction volume. Total, they've already moved $1.5 trillion from one country to another on behalf of their institutional customers. And as I noted, most of these crypto remittances, remember it's only 3% of the market right now, they're not done via Bitcoin. They are being done with stable coins. We just saw the Genius Act passed, the first piece of crypto legislation. It was entirely and specifically focused on stable coins because this is a really big deal. In fact, Goldman Sachs calls stable coins crypto's first killer app. Already, stablecoins hold 10% of all the US currency in circulation. That's almost $250 billion. And the Secretary of the Treasury says the stablecoin market is going to hit $2 trillion in just the next 2.5 years. That's an 8x increase from where we are right now. One interesting thing about stablecoins, they offer no yield. You put your dollars into a stablecoin, it's backed by US Treasury, but you don't get the Treasury yield. This is why Tether, the world's largest stablecoin, made $13 billion last year. That's more profit than BlackRock made. It's more than Schwab, more than IBM, more than Target or Delta or Salesforce or FedEx or John Deere or Abbott or GE or Ford or McDonald's. Tether, who most people have never heard of, makes more money than all of these companies because they take your dollar that you put into the stable coin, they buy a treasury to protect your dollar, and they keep the interest earned on the T-bill. Boy, how come I didn't think of that? It's brilliant. It's so brilliant that a consortium is being developed by Citibank, JP Morgan, B of A, and Wells Fargo to create their own stablecoin to compete with Tether and Circle. Fiserv, which provides services to 3,000 regional and community banks, is developing its own stablecoin for their benefit. Amazon, Walmart, Expedia, and Meta have all announced plans to launch their own stablecoins as well. We now already have a couple of interesting products on the market. First one was built by Franklin Templeton, quickly followed by BlackRock. Franklin's is called Benji. BlackRock's is called Biddle, which is a bit of a joke in the crypto community. These are money market funds, just like any other money market fund, except They are on chain. You don't get Benji in your brokerage account. You download the app on your smartphone and you can move money from your bank via the app into Benji, and you own shares of the Benji money market. And because it operates on chain, it is much cheaper than the ordinary everyday average money market fund, meaning, translation, it pays a higher yield than you get in other money markets. These are the first ever on-chain money market funds. And already Franklin has amassed $800 million. BlackRock's got almost $3 trillion in these, and we're just getting started. Now you're beginning to get a sense of why there's 65 million Americans who own Bitcoin, including 28% of US adults. PayPal allows all of its users to use Bitcoin to pay for products and services on its site. Walmart has installed Bitcoin ATMs around the country. Both Schwab and Fidelity have their donor-advised funds that accept Bitcoin and Ethereum on their platforms, so you can make charitable donations in Bitcoin. You can make political contributions in Bitcoin. In many states, you can pay your taxes in Bitcoin. Many colleges let you pay tuition in Bitcoin. It's really rather astonishing. When people say to me, oh, what's crypto good for? There's no use case. Really? Here's a list of the B2B uses. Here's a list of the B2C, C2B, and C2C uses. And this is all partly helping you understand why Donald Trump says he wants to make the US the world capital of crypto. He has really come true on that campaign promise. He's created the first AI and crypto czar. The head of the Presidential Council of Advisors for Digital Assets, a brand new position. His chair of the Council of Economic Advisors, all strong crypto supporters. The secretaries of Treasury, Commerce, and Labor, all strong crypto supporters. Every member of the cabinet personally owns Bitcoin. The chairs of the SEC, CFTC, FDIC, OCC, SBA, they are all strong supporters of crypto. And this support spills over to Congress. The chair of the House Financial Services Committee, the Senate Banking Committee, both of the brand new digital assets subcommittees, all strong supporters of crypto. It's a majority in both parties in Congress, which is why we saw all three bills move forward in the House this past week, something we never saw in the Biden administration, and certainly nothing like this under Gary Gensler's tenure. We've got the Genius Act, which created the crypto stablecoin legislation. We have which the president is already out of the House and in the president's hands for becoming a bill, signing a bill into law. The Clarity Act, which is advancing in the Senate very quickly, which provides rules of the road for who will regulate this, a question Gary Gensler refused to answer. It's going to be predominantly the CFTC. And then the Anti-CBDC Act to make sure that it is the stablecoins that operate in this country, not a government-issued stablecoin, otherwise known as a CBDC, a central bank digital currency. All of this represents a total reversal of the Biden administration. In 2019, the SEC and FINRA issued a joint statement saying, well, I'll tell you what it said in a minute. That was July 2019. The OCC issued a statement in 2021. The Fed issued a statement in 2022. All three of these statements said that banks and broker-dealers cannot trade or custody crypto. This kept Wall Street out of the crypto marketplace. March 7th of this year from the OCC, April 24th of this year from the Fed, and May 15th of this year from the SEC and FINRA. All three of those letters were rescinded by the Trump administration. The Department of Labor, back in 2022, said that they will investigate and take appropriate action against any employer that dares allow Bitcoin as an investment option in a 401k. This shut down the notion of buying crypto in your retirement plan at work. The DOL killed it in 2022. May 28th of this year, that was rescinded. Over the next year, you're going to see 401ks all over this country making Bitcoin available to their workers. The Treasury Department and the IRS back in December of 2024. Think about this. The election is over. Trump wins. Kamala Harris loses. Biden is out of office in a month. December 30, 2024, the last day of the year. The Biden administration has the Treasury Department and IRS issue a new regulation demanding that crypto exchanges and brokers file reports and gross proceeds data to the IRS. Hugely burdensome and cumbersome. And on July 10th, the Trump administration's Treasury Department rescinded that rule. This is a total reversal of policy from the Biden era to the new Trump era. It's such a reversal that the S&P 500 in May added Coinbase to the S&P 500. Now, think about that. Company gets big enough, its revenues grow, its market share rises, the market cap is huge. So the S&P committee says, time to add it to the index. And anytime they add a company to the index, where does it show up in the index? Well, you would expect, maybe number 480, 470, 450. It's new, it's therefore growing, but it's still pretty small compared to the rest of the S&P 500. When the S&P committee finally said yes to putting Coinbase into the S&P 500 index, it came in at number 157. What took the S&P committee so long? It was bias promulgated by the Biden administration. Those biases are now gone, and Coinbase is at 157 in the index. Take a look at JP Morgan's Jamie Dimon, who in 2019 said, I'd fire in a second any trader who's trading Bitcoin. They are stupid. And this year he says, we're going to let our customers buy Bitcoin. On June 4th, BlackRock's Bitcoin ETF, IBIT, is now usable as collateral at JP Morgan. And Jamie Dimon said on June 4th, I defend your right to own Bitcoin. What a total reversal of position. And you've heard about the Bitcoin Reserve. 28 states are working on buying Bitcoin with government money. The laws have already been passed by Arizona, New Hampshire, and I got to update this slide. Now Texas as well has said that. This is why, like I said, 65 million Americans own it. In fact, 83% of those investors call themselves long-term believers. 72% say crypto is a key component of their wealth strategy. 69% plan to buy more crypto over the next couple of years. And it's not just all investors. Look at millennial millionaires. 8 out of 10 of them own crypto. Teenagers, when offered $100 to invest, 57% say they would use the money to buy crypto. Only 38% say they would buy stocks. You really think they're going to change their mind as they age? I don't think so. Half of all teenagers say crypto is the future of investing. Billionaires own Bitcoin. Endowment funds own Bitcoin. Pension funds own Bitcoin. Half of hedge funds own Bitcoin. 3/4 of family offices. And institutions, when the Bitcoin ETFs first came out in January of 24, look at the number of public companies that have to file 13Fs. Look at the number of them that own the Bitcoin ETFs. Today, it's nearly 2,000 of them, and the number is growing every quarter. 83% of institutions said they're going to increase their exposure this year. 84% are already using stable coins or say they're working on it. 3 out of 4 tend to invest in tokenized assets by next year, and 90 companies that are publicly traded already have Bitcoin in their corporate treasuries, and 25% say they're going to by the end of the decade. Governments are also huge owners of crypto, and so are financial advisors. Half personally own Bitcoin. But Bitcoin is just the beginning. The real big thing is tokenization. You've heard of NFTs, non-fungible tokens. The very big deal was when Beeple, Mike Winkleman, sold this image for $69 million back in 2021. And that just blew up the whole market of NFTs, of everything from the Bored Ape Yacht Club to crypto kitties and on and on. Everybody got into tokenizing, even including the NBA, Dolce & Gabbana, Burberry, Tiffany's, all letting you dress up your avatar that you use in your online games. And yeah, Fortnite has 500 million people playing, 2 million users a day. They generate $5 billion a year in revenue, and it all comes from that online clothing. It's those Nike sneakers that you buy for $8 to dress up your avatar. This is big business. Or is it? Whenever I talk about this, a lot of people say it's not really a big deal. They're not impressed. They say, look, I'd be really impressed if you could tokenize real estate or stocks. Well, guess what? We are tokenizing real estate. The very first deal was done in 2018 in a condo building in Manhattan. In 2020, the St. Regis Aspen was tokenized. In 21, the G999 Tower in Dubai was tokenized. They're now working on tokenizing $16 billion of real estate over the next decade. In Japan, there's a fund that's tokenizing $75 million worth of Japanese real estate on the Oasis blockchain. Their goal is to tokenize $200 billion of Japanese real estate. That's real estate. Let's now talk about the stock market. Ever heard of Denari? It's the first broker-dealer to get SEC and FINRA approval to offer tokenized stocks, crypto, and stablecoins. Superstate lets public companies issue shares directly on chain. You can already get tokenized shares on Bybit, Kraken, and Solana blockchains. Robinhood is building its own stock tokenization service on the Arbitrum blockchain. Upexi is the first company to issue its shares. It just didn't go public on NASDAQ. It also did it simultaneously on a blockchain. Ever hear of the Canton Network? It's a joint venture of Goldman, Microsoft, Deloitte, and CBOE, the Chicago Board Options Exchange. This is a massive activity. 24/7 trading, instant settlement. You can program the equity. This is why tokenization is the future. We've already got $4 trillion of real-world assets tokenized. 2 trillion a month in monthly transaction volume. There's been 100 billion of repo transactions per day. We've got 100 issuers around the world tokenizing all different kinds of securities. And what's coming? Tokenization of tickets to sporting events and concerts. We're tokenizing rare wine, exotic cars. The Norwegian Seafood Association is tokenizing salmon. Breitling is tokenizing its watches. Why? To track counterfeiting. Major recording artists are tokenizing their music. Why? So that instead of you being a fan of Taylor Swift, listening to her music on Spotify, now you can be part owner of her music. So whenever that music is played, you get a piece of the royalty. It's already being done by Warner Music. There are advertising incentives, content creation, gaming, gambling, social media, all kinds of stuff. In fact, your driver's license is going to be tokenized. Think about that. Why are we carrying a piece of plastic in our pocket or purse of our driver's license? Why isn't that an NFT? Why isn't it a unique digital token that we have on our phone that we can just transmit or display when we wish to those we want to see it? Passports, medical records, employment records, academic records, safety and maintenance, deeds and titles. Even your house will be tokenized in the future. This is the biggest asset for most clients, right? They get to retirement, they need more income. Their house is worth a ton of money, but they don't want to sell it. They don't want to get a reverse mortgage. How do you monetize a house? You tokenize it. You take the $1 million house, you create 1 million tokens of $1 each. You sell those tokens one at a time as you wish. Investors buy the tokens because they want to own a piece of your home because of the appreciation potential of your real estate. You get the income. You create liquidity for your house without having to sell it. Athletes are already tokenizing their salaries. How would you like to buy a piece of the contract of your favorite quarterback or rock and roll star or Hollywood actor or Broadway performer? This is what's coming. Boston Consulting Group says the global market for tokenized securities by 2033 will be $18 trillion. Yeah, crypto has become a mainstream asset class, and I believe it offers the best opportunity for long-term appreciation. JP Morgan says Bitcoin's going to be 150,000 by 2030. Coinpedia says it'll be 350. Matt Hogan at Bitwise says it'll be 1 million. Jack Dorsey says it'll be 1 million. Alliance Bernstein says it'll be 1 million. Kathy Wood says it'll be 2.5 million. And Michael Saylor says it'll be $5 million. The Association of Governing Boards of Universities and Colleges says crypto is going to produce the world's first trillionaires within the next decade. It's all about supply and demand. We mine 41,000 Bitcoins every 3 months. This is not a seminar on Bitcoin mining. You can read about it in my book, The Truth About Crypto. But we produce 41,000 new Bitcoins every 3 months. Look at all the different groups of investors who are buying Bitcoin. Look only at this fact. The number of Bitcoins that these groups bought in Q1 of this year. In fact, let's not look at all of them. Let's look only at publicly traded companies. We're going to ignore all the institutions, all the retail investors, all the advisors, just the publicly traded companies. In Q1 of this year, bought 95,000 Bitcoins. There are only 41,000 produced. There's a huge imbalance between supply and demand. And this is why the price of Bitcoin is going to skyrocket. Look at the global value of the stock market. All the stock in all the world, it's about 175 trillion. Look at the value of the bond market, the real estate market, gold market, cash market, Bitcoin around the world. You add it all up and it's about $750 trillion of assets. If everybody who owns all that stuff allocates just 1% to Bitcoin, that's $7.5 trillion in flows, which is worth almost 400 grand. You add it to Bitcoin's price as of 12/31, and you hit 500,000 per Bitcoin. This is why I think Bitcoin will be 500,000 by the end of the decade. And in fact, there are now dozens of ways you can allocate. It's never been easier. You have companies that are offering these opportunities left and right, including household brand names that you know very well. You have companies that are only doing crypto funds. You've got Bitcoin ETFs, 2x ETFs, futures and options ETFs, income and buffer ETFs. People say you can't earn yield on Bitcoin. Not true anymore. Now you can, thanks to the options market. You also have ETFs that will insulate you against big market declines. You're afraid Bitcoin might fall 50%? You can buy an ETF that guarantees you won't lose more than 10. There are combination ETFs. You can short Bitcoin if you want. You can do all this with Ethereum. And if you want to go beyond Bitcoin and Ethereum, there are over-the-counter funds and a wide variety of coins available from Grayscale and Osprey. Bitwise offers the 10 crypto index fund. It's kind of like the S&P of crypto, the top 10 digital assets in a single ETF. Sorry, not an ETF, but it kind of looks like one. If you want to stay with equities, you can invest in the stocks of Strategy or Tesla. Bitwise has an ETF that invests exclusively in publicly traded companies that invest in Bitcoin. There are also Bitcoin miners, and Grayscale offers an ETF of those Bitcoin miners. You also have equity ETFs that invest in crypto from big name ETF providers. There are SMAs and TAMPs. There are private placements. You can do this in your retirement account with a bunch of IRA custodians, as well as 401k providers coming real soon thanks to the Department of Labor rule change. You can now incorporate crypto really easily into a client portfolio. And that's why the new allocation model is to go beyond the traditional 60-40. Remember, the opportunity is vast. Blockchain is growing really rapidly, as is the metaverse, tokenization, and Bitcoin itself. This is why we need to update and expand the glide path, and we need to overweight exponential technologies. Just look in the world of stocks. These technologies that we've talked about belong as a significant exposure in a client portfolio. And in the crypto sleeve, you can buy Bitcoin as a store of value, Ethereum, Solana, and others for commerce, crypto equities, tokenization, and the metaverse as well. Bottom line is, we want to recognize that we are 70 to 100% in stock and crypto. bonds 0 to 30. And depending on where you are on the scale of risk tolerance, somewhere between 10 and 40%, even conservative investors at 10% allocations. So I've got just one question for you, and then I'm going to kick it back in a minute to Anthony. Here's my question. Are you a fiduciary, or are you just an order taker? Very often I find financial advisors telling me they are not recommending Bitcoin to their client because they don't want to upset the client. They're afraid the client will fire them if they were to bring it up. Let me just show you some simple numbers. The market cap in the US for stocks is about 60 trillion. The bond market, similar. That's about 112 trillion of total market cap. Cryptos is 3 trillion. Now it's closer to 4. The crypto market share is 3%. If you aren't buying Bitcoin in your client's passively managed, diversified portfolio, you're essentially shorting the market. There's a 3% allocation you are failing to make as a passive investor. So do you believe in modern portfolio theory or not? Because if you believe in MPT, you want an improved risk-reward matrix. And a portfolio with Bitcoin has better MPT than a portfolio without Bitcoin. When you add Bitcoin to the portfolio, Sharpe ratio gets better, standard deviation gets better, max drawn down gets better, Sortino ratio gets better. All the numbers improve along with its annual return. And we know that Bitcoin has very low correlation. This is why it aids portfolio rebalancing. And there are a wide number of objections. You've got to learn to overcome them. And that's one of the white papers I wrote, the 6 mistaken beliefs that are preventing you from buying Bitcoin. You need to read that so that you can overcome those objections. I have to admit I was wrong. It's too late. Bitcoin's too volatile. Quantum computers are going to destroy Bitcoin. Bitcoin is a speculative bet. All of those are dead wrong, and you need to read the white paper to understand why. We've got to update the glide path because longevity and exponential technologies leads to crypto. 70 to 100% in equities, only 30% max in bonds. And that's why you need to read both of my white papers. The 6 myths paper and the white paper that recaps what I've just shared with you here today, the death of the 60-40, and why your crypto allocation needs to be 10 to 40%. The QR code is right there on screen. Michelle will put a link to it in the chat here on Zoom so you can easily download both of these papers. They're free so that you can read them and share them with your colleagues and with your clients. And if you really want to get a deep dive into all this, I encourage you to become certified in blockchain and digital assets. And we'll talk more about that as we continue our conversation. But I want to bring Anthony back on with us right now. It was a whirlwind, Anthony, 251 slides, I think, in about 40 minutes. Tell me your reaction to all that, what you just heard.
Well, I would say in my prior life at BlackRock, there's a gentleman by the name of Ric Edelman, you may know, who ran the Strategic Investment Opportunities Fund. He is a slide monkey too. He goes through hundreds and hundreds of slides of the most deep data that you could find. And I've always been a fan of that. I love the style. I think the important thing is it's such a complex world and it's such a complex topic, Rick, that you can't do justice without having the ability and the time to cover so many different areas, right? You're talking about macro, you're talking about policy, you're talking about legislation, you're talking about technology, and importantly, you're talking about longevity, right? Which I think a lot of folks forget to think about, that, we have to think through as long-term investors, what's going to happen to my portfolios over the next 5, 10, 15, 20 years? What does retirement look like, and when am I going to get there? Right. And I think as we think about this, we have to your point, step back and think about this as an institutional investor an endowment, as you mentioned, who invests for hundreds of years of outcomes, right? That's their goal.
So tell me what you're seeing, Anthony, in the REA community. How are the advisors you're encountering in their firms? How are they thinking about crypto today?
So specifically in the REA community, I had a great time at your event in Dallas maybe about 2 months ago. Hundreds of advisors there that we were able to speak with who gave me a lot of insight. We recently hosted our own State of Crypto Summit in New York, where we had about 1,000 people. at that event, and they were institutions, they were advisors, and others. And as I travel around the U.S. and globally, and I talk to multifamily office platforms, U.S. REAs, and others, inevitably, what I find is something in the order of maybe 10 to 20% of them have decided to make at least an allocation to Bitcoin, mostly through the ETFs. Okay, and that 10 to 20% is it's a great number, and it's great to see. And I see a number of platforms who have done this. Some systematically, some are only allowing certain client. I say the client brings it up and they say, "I'm holding crypto. I want to hold crypto," and so they have a reverse inquiry policy where they'll allow them to support it, but they won't um, really allow the advisors to sell the product or sell the idea. So we're still very early in the independent RIA space. And if we just released a report called the Charting of Crypto report at Coinbase, and in that report, there's one of the slides is really phenomenal. That it outlines, the top 10 largest bank wirehouses, so the Merrills and the Morgans and everybody else. And it shows you that of the top 10, only 4 have actually authorized digital asset exposure and have allowed advisors to open the door to their clients for that. And so there's something like $21 trillion of capital in that space that cannot access digital asset markets today.
And when you say that only a few have said yes, is it because the others have said no, or they're still doing their research due diligence? They haven't reached a conclusion yet. Which is it? That they've said no, or they're still working on it?
It was an explicit no for the last couple of years. I think we've certainly seen the tide start to shift this year with the policy environment that the Trump administration has reorganized, with the passage of the legislation that you're talking about around the Genius Bill and the Clarity Act. It's going to bring a lot of clarity to how fiduciaries, importantly, need to think about recommending, this type of exposure. And so I would say it was probably 9 out of 10 that were a no last year, and now we're probably 50-50 in terms of explicit no, and others are still doing some work on it.
So yeah, that's been my experience as well, that in talking with boards of endowment funds, pension funds, because very few of them today are doing or allocating to crypto. But what they're all telling me is that they're studying and researching and they're meeting on it. And that's why I'm meeting with these folks, because they've asked me to come in. You and I have done some joint meetings together with some pension funds. These folks are really serious
What
about
you find,
this.
yeah, what you find too is the trustees and the board members. These are policemen and firefighters who help steer the decision making to some degree of the pensions in particular. Are they themselves are eager to understand. They can invest in the asset. They understand. Maybe 2 or 3 of them really understand it and have spent a lot of time getting educated on what digital
Right.
asset is.
Right.
The other 6 to 8 in the committee are being educated, right? And it's happening in real time. The big allocators are big ships, right? They're the big warships, and so they're investing on behalf of millions and millions of constituents and beneficiaries. They don't move fast, but they are absolutely doing the work right now. And on the endowment side, I think a lot of the endowments are also coming in and doing the work. Many of them are hung up on private markets. They went so deep into the alternatives and private market space over the last 10 to 15 years as that diversifier and that reach for excess return that they couldn't get in the public markets. They went really deep in private markets. So now they're trying to unwind some of that exposure and looking at digital assets as an option where they can make a small allocation and has a very big impact to total portfolio returns.
I made a comment that if you're going to allocate, you can invest in Bitcoin, which I labeled store of value. Do you agree with that premise that Bitcoin is a store of value? Is that a way to define it?
I think it's interesting because if you talk to the market today, largely would tell you that Bitcoin has kind of left the narrative of being a crypto asset to some degree, which doesn't make sense because it's all crypto and it's cryptography and it's a technology conversation. But a lot of investors get hung up on lumping Bitcoin and crypto and meme coins and all the other stuff that comes with the technology. together in the same bucket. And they say, well, I'm going to ignore Bitcoin because it's associated with different activities across the digital asset ecosystem. And the thing that people have to remember is this is all the evolution of the internet. When we talk about the internet 1.0, it was people were logging onto the internet for the first time, sending emails, using cryptography to send a data package from peer to peer, right? And that was a novel thing for the internet 1.0, and then searching websites for information. And you had enterprise adoption and consumer adoption from the 80s to 90s and into the 2000s. Internet 1.0 brought everyone online. And I remember logging into America Online and
Yeah.
paying, $50 a month or whatever it was back then for it, because they couldn't service that many people. So they were able to charge a lot of money for that. Internet 2.0 was really the adoption of mobile and the iPhone. And that connected all of us to video and social and messaging. And now we have billions and billions of people on Internet 2.0, and our entire financial system largely runs financial and social ecosystem largely runs on Internet 2.0. And so what crypto is it's Internet 3.0. So we're taking people, data, and money and moving it on blockchain rails, which are the evolution of the internet. And so today, people are logging in onto these protocols. They're getting on chain, as we say, instead of online. And they're figuring out, how do I send and hold money? How do I hold value on this new internet? And how do I send it from peer to peer or from institution to institution? Bitcoin was the first protocol of Internet 3.0. Okay. And so this is really important for everyone to understand is Bitcoin is a protocol just like TCP/IP and other things were a protocol that allowed email to exist. And so Bitcoin network is a protocol. It is the one of the tools inside the internet of money. And so as you have this expansive universe of different mediums of assets that will move across the internet of money, Bitcoin's one. Now, to your question about store value. Now, what everyone thought with Bitcoin, and it may still come true in 50 or 100 years, we don't know. What everyone thought with Bitcoin was this was a peer-to-peer payments and cash system, right? And they said this is really novel and unique because we have censorship resistant money that is not tied, it's not a liability of a government, okay? It's decentralized across millions of nodes, and it allows me to send you money peer to peer without any central actor. It settles near instantly, and it's very cheap to do. That was the vision for Bitcoin. Now, the reality of it was designed with a fixed supply cap and a controlled emission schedule. Maximum 21 million coins, and now we're in the fourth major cycle, and we're at I think like 0.83% inflation rate on it. And so there was a lot of inflation early on as the network tried to give away tokens to people so they would join the network. And here we are in 2025 where there's only a little bit of inflation and it's systematically reducing every 4 years. And now there's hundreds of millions of holders of these assets because it's fixed supply. And you said it earlier, there's so much demand that it's driving the price higher, right? And this is the thing that people need to understand, that this is one asset in the internet of money that in and of itself is being used by the market as a store of value. Now, we define store of value similar to gold. In you're holding an asset that A, doesn't have any connection or liability to governments, B, doesn't generate a yield, so it truly is a commodity, okay, and C, it trades way above its utility price. Right? And so that makes it look a lot like gold, right? We don't really use gold in industrial production anymore. It's too expensive. The market for thousands of years, and especially increasingly over the last 50, 100 years, uses it as a hedge on macro uncertainty, and has used it as a hedge on monetary debasement. So gold and Bitcoin are very similar, and they're both, in our view, in the store value bucket for those reasons. Bitcoin, we don't really use it for payments. Right? The network settles every 10 minutes. Okay. It's not the fastest, cheapest network to use for payments. Right. The value of that Bitcoin to me is very valuable, and I don't want to pay anything in Bitcoin. I'll pay in dollars. Right. I'll borrow in dollars and buy Bitcoin, and that's what the market's choosing to do. So it's very much a store of value. And what this means for the market of investors is they should probably start thinking about Bitcoin and gold together as a store of value. And we wrote a paper on this, and hopefully Michelle can link it in the notes, where we think at Coinbase Asset Management, we think that this concept of thinking about Bitcoin and gold as a store of value actually creates an entirely new asset class for portfolio construction. Because today, what happens with gold is you put it in the commodity bucket, and it doesn't necessarily act like a commodity. The job of gold in your portfolio is not the same as palladium or
Yeah.
corn or anything else, right? Those are different supply demand driven market economies. The job of gold for investors is macro uncertainty, monetary debasement, and so is Bitcoin. So we think they go together. We do think it's a store of value. We'd love to talk more about that with anyone that wants to learn about it.
So that leads me to my next question. And then after this one, we're going to jump to the questions folks have posted, which are really good questions, and a lot of them. Now that you have made the jump over the last several years from BlackRock and the TradFi world over to crypto and here at Coinbase, now you're the president of Coinbase Asset Management. What's on your agenda, Anthony? What can advisors expect to see coming out of Coinbase Asset Management?
So our agenda is to build products that are scalable and easy to understand, that deliver excess returns to retail eventually, but today to institutional investors at large. And so we think that the market today, the retail investor today has access. They have access to Bitcoin, right? Either through the ETF or through direct acquisition. If you open an account at Coinbase, you can go buy it. And there's a slew of other asset managers also that offer different ETFs. There's a number of different index products, right? So it's not about not having access to what largely is beta exposure. That's the question that most advisors are wrestling with today: is how do I get educated on this? How do I convince my investment committee to get over the hump? How do I how do I get started? We talk a lot about this as just get off zero, right?
Right.
And so from our perspective, our goal, Coinbase launching the asset manager, um, is really a focus of like, how do we build products that are going to make it really easy for people to get off zero, whether it's an institution, a large distribution platform, a multifamily office, or even retail investors. And we're going to continue doing that. We've done it at the direct spot exchange level, and we keep building products in that space. On the asset manager side, we know that advisors need a fiduciary behind the door, right? They need someone they can trust that operates in an institutional framework with the right controls and risk management behind it to build products that they can then sell to their clients. So how are we doing that today? We've launched our flagship fund is a Bitcoin yield fund. I mentioned that at the beginning. Okay, and so the Bitcoin yield fund assumes that you are already able to access something like the ETF. Here in the next few months, you're going to have the ability to go in kind in or out of the ETFs. This is going to be another major unlock for the market
Yes.
structure of digital assets.
Yes, that was a ridiculous requirement of Gary Gensler that has made no sense, has not been applied anywhere else. And the Trump administration, the SEC, will undo it, no question.
Right. You also have to understand that Bitcoin is viewed as general collateral, right? And in a world where we are kind of stuck in centralized ecosystems, and now we have this idea where I have this liquid store value asset that is general collateral. I can hold it in self custody, or I could keep it on exchange, or I could keep it in a fund, right? The way that we think investors are going to hold their Bitcoin is going to be very diverse. And so our fund is structured so that if you're holding Bitcoin today, spot Bitcoin today, you can in kind subscribe with your Bitcoin into the fund, right? And there's no tax impact to that. So there's a lot of investors who are sitting on very low cost basis Bitcoin that are very excited about generating an incremental yield on top of that, and they would want to in kind their Bitcoin into our fund. So for advisors that are listening, they think about one, it's usually pretty lumpy. It's like maybe 5% of your clients are holding crypto away somewhere from you and have a lot of size, and you're now helping them think through that. This could be interesting for them to think through, what do I do with my Bitcoin now that I've amassed so much wealth in it and I have low cost basis? Can I generate yield with it? That's what we do with that product. right?
So that's a good illustration of the innovations that are coming and how there's so much more to this than people might think at the surface, and how innovative ways advisors can provide value to their clients. That it's going to make the client more dependent on the advisor, not less. And I think that's great news for everybody.
Yeah, and you talked about stablecoins earlier, Rick. You have to understand that if this is the internet of money, and all enterprises, all institutions, retail, consumer will be logging on, right? Which means they're going to get a Web3 wallet. The wallet will be embedded into their apps that they use today. The wallets will power stablecoins, crypto, NFTs, anything that runs on this internet of value, including Bitcoin, everything else. And in addition to that, when they're operating on the next layer of the internet, we call it Web3, then you're going to have, there's a lot of leverage, there's financial services, there's investment products, there's going to be all kinds of new things that people can do with the value on that internet rail. And so stablecoins, right? It's a $250 billion product category, top 10 buyer of US Treasury debt, and now legal under US law, under the Genius Act, and turned over $27 trillion in notional volume last year globally. So the stablecoin market is rivaling Visa, MasterCard, all the other big payments platforms, and you can participate in it, right? So if there's $27 trillion of volume happening on its way to 100 in the stablecoin economy, where more and more institutions are bringing stablecoins into their payments processing, you bet yourself that it's going to be leverage, it's going to be credit, it's going to be cash flow, right? You're going to see more and more. And so look at the corporate treasuries today, right? The corporate treasury vehicles, they are raising money from traditional markets to go buy crypto, to then have crypto and mostly Bitcoin on their balance sheet, and the market's rewarding them with a premium on equity value over that Bitcoin. So MicroStrategies and everybody else that's doing this. Well, guess what? They're going to start using stablecoins.
Yeah.
So this technology is going to continue to get integrated into those systems. And when we think about that at Coinbase Asset Management, our goal, we know that Coinbase has already solved your access to stablecoins, and they built wallet infrastructure to bring thousands of corporations and enterprises on chain. We want to find out ways to make money from that. So there's tremendous demand for capital in this space. There's tremendous demand for leverage. There's tremendous inefficiencies still because it's new technology. And so we've launched another fund that's USDC Alpha, right? It's a USDC high yield fund where we build protected, safe ways to lend USDC in the on-chain ecosystem. And so it's a great way for someone who's wanting to participate in the investment returns of Web3, maybe without taking on a ton of directional risk in their portfolio. And we think those are going to be complementary strategies. So we've talked about store of value, Bitcoin Gold, right, is in and of itself, we think it has a role in a new asset class in your portfolio. You can put a real return target on that. We talked about Bitcoin yield. So if you want the beta of Bitcoin, but a little bit more, then we're building strategies there. We talked about USDC yield, right? Taking advantage of the demand for leverage and capital inefficiency in this space as it's growing and maturing, right? It's going to be a really, really neat place to put on some risk. And so, the last piece is just indices. We've got the Coin 50 is a product we launched earlier last year, actually. And so now that product is being licensed out to different players, both ETPs, perpetuals. You'll see index products being launched on that too. So if you as an advisor platform decide, we want to launch a single fund omnibus vehicle for all of our clients, and we want it to be an index strategy, you could choose to do that with the Coin 50, right? And so there's a lot of simple ways through to build into this theme, and you can run through Coinbase Asset Management, which is what we're trying to do.
So there's a lot of excitement coming and a lot of new ways to invest, as I mentioned in my slides. And for advisors to still be on the sidelines and oblivious to this, paying no attention, is just a huge mistake. The asset class is huge. It's growing. You need to figure out how you want to engage and what makes sense for your practice, for your firm, and for your clients. And it's easy to come up with an answer. You mentioned earliest on at the top that Coinbase Asset Management is separate from Coinbase, the parent company. Is there a different way that people can reach you, Anthony, and Coinbase Asset Management? how can folks reach you?
Yeah, the best ways is email. My email hasn't changed. It's anthony.basili@coinbase.com. But Twitter, I'm on there as smartest beta. LinkedIn, you can hit the follow or connect button, and I haven't hit my 30,000 followers like you have, Rick, so I can still add some people.
Michelle will put into the chat your email address so people can, because I know folks are going to want to talk to you. So we'll do that. Let's jump into the questions that people have been posting here. Some of you did in advance. When you registered, you sent in a question. Others of you have typed it in into the Q&A during this presentation. Let me just jump to some of them. This one we've got from 2 or 3 different people. I cited, they're referencing the fact that I talked about how favorable the Trump administration is compared to the Biden administration. And so the question that several have asked is, could the next administration reverse what the Trump administration is doing, taking us back to a Biden era? Could that be done?
We haven't hit midterms yet. And I think we have a lot of ground to cover between now and midterms. If I were to think back through the work we did at Coinbase to get us here, right? Tremendous activity on Capitol Hill with the White House, with both sides of the aisle, to build support and understanding and knowledge around the fact that this is just a technology and it's not bad. And I think what we've seen in the response on both sides, for Republican and Democrat, was largely agreement towards that. There were some big naysayers in the prior administration and the Biden administration that had a lot of influence. But I think we've hit a completely new turning point today, right? The big rocks that we really wanted to get done were getting stablecoin legislation done this year ahead of midterms, and getting Clarity Act, like some kind of market structure bill done this year. And guess what? Stablecoins signed into a law, or it's going to be signed into a law. It's been passed by both the House and the Senate. The Clarity Act, which brings a focus on assets that need to be governed by the CFTC versus other assets that are securities under the SEC. It has a pathway for tokens to become decentralized after launching and issuing. That was one of the biggest things we could have ever accomplished, and we're very close to getting it done. So it's passed the House.
I'm not sure if Anthony froze or
and we
if I
needed to
did.
pass the Senate. Once those two bills,
Okay.
are you losing me?
I'm not sure if I'm losing, if I'm the one whose internet is weak or yours.
Yeah, it might be mine.
Okay.
I think I'm back. So I would say once those two bills are passed, you've got they could certainly be undone with enough effort. But again, this is just technology. I think the train has left the station. The global policy, the global governments, global policymakers, everyone understands that stablecoins are good for America.
Yeah.
From a dollar perspective, everyone understands that Bitcoin, has a role in this monetary shift that's going on, right? And so as we continue down the path of dollar debasement across all fiat currencies, it's not just the U.S. dollar. It's all fiat currencies. 200 something countries, right? They run on dollar, or let's just say a fiat network, right? Where people agree to participate in the network of their currency. And Bitcoin is a very similar concept as are other digital assets.
Couple of questions about stable coins. One, why would all these companies want to issue their own stablecoin?
So the way that the products are designed is it's designed to be a permissionless dollar on the blockchain, where anyone can send that dollar peer to peer from me to you anywhere around the world, and it settles instantly. So it's a incredibly powerful technology, right? One of the most transformative monies that we will ever see in our lifetimes we've ever seen, right? Now, the beauty of the stablecoin is that it holds U.S. Treasuries behind the scenes or similar high quality reserve assets, and well, in the case of Genius Bill, it's basically said that they can't pay interest, which means that the issuer of the stablecoin keeps all the interest. So all these companies who they themselves are their own network effects. Amazon has its own clients, its own network, Walmart, Fiserv, right? Apple, you name it. Every one of these companies wants to, because they're publicly traded and they have to make profit, they want to figure out ways to generate money and keep their users in their ecosystem.
And
So,
one way they can easily do that is they can say, look, I can't pay you interest on your stablecoin deposit, but I can give you a discount when you buy stuff from me. I can offer you loyalty rewards points. I can, just do different things to, because they got this newfound money, they got all the interest they're getting on treasuries. They don't have to pay out. That gives them ability to do things to attract and retain their customers.
yeah. And you should, the market expectation is that, like, if you're going to launch a stable coin, you're going to go get licensed on the Genius Bill, because there's a supervisory responsibility to that. So not everyone's going to be approved. Number one. Number two, that they're going to deliver value to you, right? Hopefully that's the case, right? And the market's the best arbiter of value creation. And so I think we're going to see an explosion of stablecoins, and you're going to see hundreds, maybe thousands of new entrants into the space over the next 24 to 36 months. And then you'll probably see consolidation again once the market figures out what's not efficient and what is efficient for us to be able to send and remit money back and forth. Largely, what may happen also is we may see a lot of the different brands of stablecoins. Maybe there's going to be a lot of brands at first, and then the market's going to get a little bit overwhelmed, and they're going to say, "Wow, I don't really know what to do. Right? You don't support this, and you support that." Guess what? This is how decentralized finance works today. It's amazing new technology, but certain assets don't move on certain networks, right?
Let's keep in mind that in 1920, there were 200 automobile manufacturers in the US. And
Right.
today there's, three and a half. And
Mhm.
so the market figures it out. Coming out of World War II, the two biggest airlines were Eastern and Pan Am. The airline industry is bigger than ever, but those two are gone. So the market figures things out. The industry will grow. The individual players may change.
Right.
It's all part of the fun. Regarding the funds you described that you're building at Coinbase Asset Management, this question is, are these funds currently available, or are you going to anticipate they will be available at the various custodians, Schwab, LPL, Pershing, et cetera?
Yeah. So today it's directly through Coinbase Asset Management, and what we're doing is we're setting up different feeder structures with third-party distribution platforms. We envision getting to the Schwabs and the LPLs of the world, and if you want to talk about having the conversation, we definitely would be open to it.
You referenced mining, and you talked about the Bitcoin halving, which has been just steadily declining. The very first they used to issue 50 coins every 10 minutes. Now we're 3 1/8 coins, and it's soon gonna, drop even further than that. And so the question from Rudy here is, what happens after the last Bitcoin has been mined? How will the miners still make money to keep doing what they do?
Well, the miners do more than just mining new Bitcoins. They also process transactions on the blockchain. Okay, so part of the process is that the Bitcoin miner is processing the fact that I sent Bitcoin from my wallet to your wallet. And so as more and more users, both, it doesn't matter if you're an institution, an individual, or anything, like if you're accessing this on-chain economy and you're sending Bitcoin across the Bitcoin network, this is a transaction that has to be settled by the blockchain, and the miner processes that transaction. So there will always, perpetually, as long as the Bitcoin network is around, which we expect could be a millennia, right? It will definitely be up until at least 21, what is it, 2100, when the
40,
last
2140.
2140, when the
Yeah.
last Bitcoin comes out, and we're all gonna have a big celebration that day. But what will happen at that point, if you want to look farther out into that curve, is that's 100 years from now. So um, we'll see what large scale global fiat currencies are still around, and some of them will go away. There will be a large monetary regime shift, which we think is taking place now. And 100 years from now, if Bitcoin continues down this trajectory, it may be that currency that is used in lieu or next to gold, right, for payments and store value and everything else. And and we just don't know, so it's all speculation at this point. But that's the design behind it, is to build a more stable and secure dollar, right, or store of value that we can use to store value and for means of transfer and payments. So that means Bitcoin mining will be around forever as well.
This has been fascinating conversation. I'm really excited about what Coinbase is doing, and Anthony, you leading the charge there for them, because I think it's just going to be really impactful to a lot of folks. We need to wind this down. We've kept everybody here longer than we normally go with a webinar, but there was just so much content we wanted to convey here today. Thank you all for joining us on this journey. I encourage you to read the white papers that I've written. The links are there in the chat, or go to dacfp.com. And access them. As I'd mentioned earlier, if you really want to become fluent in this conversation, you should become certified in blockchain and digital assets. This is our very popular online self-study course. You get up to 18 CE credits. The first half of the course is on the tech. The second half, all about practice management, the investment thesis, portfolio construction, regulation, operations, compliance, crypto taxation, how to talk about this with your clients and answer their questions, and a whole lot more. You get to proudly display the CBDA designation, which is listed in the FINRA database of professional designations. Be sure to read my #1 Amazon bestseller, The Truth About Crypto. Give it to your clients. It'll really help them understand what all this is all about and make them understand why it belongs in part of a diversified portfolio. Anthony, this has been terrific information. Thank you so much for joining me here today and conveying all this. Congratulations on your new post at Coinbase Asset Management. We're going to see some pretty exciting things coming from you guys before too long.
It's been a pleasure. Thanks, Rick. It's great to be here.
Thanks, everybody. We'll see you again soon.
Bye-bye.